Retired or soon to be retired? Do you want to make sure your investments continually outgrow your expenses throughout all your retirement years? Do you have questions about your health, your fitness, professional money management, Social Security benefits, or how to give to those you love without giving up control over your estate? Welcome to Financial Freedom with Paul Taylor, a show about living the best years of your life your way. Now, here is your host of Financial Freedom, Paul Taylor.
Good morning, Charlotte. This is Paul Taylor. Hope everybody's doing well this morning. We're actually doing our show live, so if you'd like to give us a call, you can give us any questions or want to talk about something. You can call us at 704-570-9610. Live at the show, once again, 704-570-9610. Just a little bit about us. Our show is designed to bring you knowledge and not a bunch of product and sales pitches. I was actually driving in this morning and was kind of laughing at some of the commercials and stuff I heard on different stations. So we're not here for that. We're here to give you knowledge because we believe that knowledge is money and knowledge is wealth. We've got a special guest here today, Brian Geiser, which we'll get to in just a moment. First of all, I want to talk about a number of things that happened in the week. Wall Street wrapped up the week with a split decision as the early enthusiasm for the latest jobs report faded, which I kind of laugh at that because the report showed that jobless rates have slid to a 7.8% 4-year low. And the economy created a whopping 114,000 jobs last month. If you remember about 4 years ago, it took about, well, actually, even today, it takes 250,000 jobs a week just to stay even with the workforce that's coming into from graduation and from other needs or just coming to age for work. So we still are very weak in our jobs. The Dow Jones Industrial added 35 points while the NASDAQ shed 13, and the S&P 500 lost a half point. The index also sacked a 2-week losing streak. Elsewhere, Consumer Reports is giving the Apple's iPhone, the iPhone 5, a thumbs up despite the widespread complaints about its map service. The magazine's reviewers said the service is competent enough even if it fails or falls short and was available free on other phones. So Friday, I believe, was 1 year since Steve Jobs passed away and had a 70% increase in Apple stock since that time, which is pretty incredible. Usually when a CEO or a president of a company passes away, stock becomes very volatile, and Apple continues to grow. Well, with that being said, nothing more boring than talking about a bunch of markets. Let's do a little bit of topic today. I want to spend some time on what to do in this sideways market. A lot of people are sitting in cash, wondering, hey, what can we do? What's our options? I'm hearing a lot on the radio about safe money, and that's that is a good option, but that's not what we're going to be talking about today. Today we're going to spend a lot of time on passive versus tactical trading, what that means, how to identify it, the type of market we're in. If you've got to realize what we're in. And Brian, are you on the phone with us this morning?
Yes, sir. I sure am.
All right.
Good morning.
Good morning. Good morning. Now, Brian is with Geiser Financial out of Greensboro. And, Brian, you also are the host of the UNC football fans, right?
Yeah, what it is the station that I have a show on is Geiser Financial on every Sunday afternoon, but I'm moving to Saturday mornings myself as of 2 weeks from today. But, what I do is I'm on 94.5 FM Rush Radio out of Greensboro, and that pretty much covers. It goes all the way over to beyond Winston-Salem, back over in Durham, all the way up into Roanoke, Virginia, down into Salisbury and those areas.
So if somebody's in the car, if somebody's in the
Carolina Tar Heels is what I sponsor. I sponsor the Carolina Tar Heel show on 94.5 every Saturday.
Okay, great. Well, so if somebody's in the car, they can tune in and continue to listen to our show. We're on for a good hour here. And once again, folks, during this hour, we want you to feel free to call in, ask any questions. It's been very confusing in these markets and what to do. But, Brian, I want to spend some time today. Let's first talk about the type of market that we are in. We are in what's known as a secular, not cyclical, but a secular bear market, and we are in the 12th year of that. And I've got some interesting numbers here before we get into that. Basically, folks, what a secular market is, and I'm going to try to bring this down to layman terms, is a market that's moving sideways. In other words, you can be in the market anywhere from 15, it can be 17 years long. We even had a 25 secular bear market back during the Great Depression, where you would have been in the market for 25 years and you would have made zero money. And pretty much
that was 29 to 54.
Well, okay. 29 to 54 exactly is what the years were. But you know what? A matter of fact, Brian, I'm going to put on my website, if folks want to go to WFNZ.com, they can link on my website, and I'll put this tactical trading chart up so you can chart up so you can see the difference between a secular bull and a secular bear market. So, Brian, on a secular bear market, which what we're in, here's some numbers that I had. If you had been in the market and you put in 10,000, 100,000, doesn't matter, whatever you put in, as of today, after 12 and a half years, you would have made an average of 2% simple interest per year.
And that's mainly because of the yield, too. That's mainly because of yield. There's not much growth. I mean, because the S&P was roughly 1460 in 2000, January of 2000. Today it's roughly 1462, 1463.
Correct.
And, I mean, we're talking minor gains, and the gains really come from your yield, come from dividends.
Correct.
And but the thing that people forget is that back in 2008, Paul, in late August, there were just a couple, 3 days where we lost 3-4 years in a matter of a couple, 3 days of all those gains. And people don't realize that the bears take the elevator and the bulls take the steps, and that can really, really affect the portfolio. And most people don't have an exit strategy. And this bear bull secular, when you get into it more in depth with this show, is going to teach them how to set their portfolio up with an exit strategy, not just sit there and ride the good times.
Yeah, let's talk about real quick, folks, what the difference between a cyclical or a cycle and a secular bear or bull market is. A secular is occurring only once in the course of an age or century, taking place over an extremely or indefinitely long period of time. So it's not just, there's always ups and downs in the market. But when you start talking about secular, you're talking about a long period of time. And if we go back to 2000, the markets were down 9.10 in 2000, down 11.88 in 2001, down 22.39 in 03. And then we had gains of 28, 10, and 4, 05, 06, 07. Finally in 08, you've broken back even. And then in 07, you've broken back even. And lo and behold, we have 08 happen, and you're back down. And finally, we're back to even, a little bit up. And a lot of the up, by the way, I was looking through the historical charts just last night, Brian, and we've had about a 12% run here in just about the last 4 months. And a lot of people don't realize that, hey, it's always been up. No, we've had a really strong run here in the last 4 months, and we can't seem to get our head above that S&P 500, 1,500 mark.
Well, they're just working off of numbers, too, from printed money. And this printed money is going to come home to roost. And the more they keep kicking that can down the road, we're going to have some drastic drops in this market at some point. Exactly when, no one knows. If we did, that person would be very rich. And if you know, please give us a call, and we'll keep it a secret, too, and we'll try to take advantage of that. But the fact is, logically, we can't just keep kicking the can down the road. And it's like you were talking about, and all the numbers that are being skewed, and they're talking about, like you said, what unemployment's now 7.8%. The majority of that is the people that stop looking. Because if the same number of people were looking 4 years ago, 3.5, 4 years ago, that were looking then, if they were looking today, our unemployment would be somewhere around 13, 14% just from that. Then if you take the people that are truly on unemployment, we're at 16, 17% true unemployment. And people can check that out on USDebtClock.org usdebtclock.org. People ought to look at that every day because that really expresses real numbers to you.
And
if it was coming off of usdebtclock.org, we would have about a 2,000 Dow right now.
Exactly, and that is a great website to go to because, Brian, I remember when we first did a show about 18 months ago together, our debt was around $11 trillion. Now we have exceeded $16 trillion. And that
was a few years ago, exactly.
Yeah, it was 18 months ago. So, folks need to wake up. They need to realize what's going on. And in a sideways market, I met with a person just this last week, and they've been sitting in cash for a long time. They just didn't know what to do. And, coming into the radio show this morning, there was people just pushing product. I heard, safety, which is great. That is one portion of the things we do. I don't want to downplay it, but it's not the only answer. And there is a way to make money in a market that is going sideways. And, I highly advise that you have professionals help you with that. You need to talk to institutional money managers, and you usually will not have access to that. And you got to be real careful who you're working with also because a typical broker is commissioned, and you really never know if they're looking out for your value for doing what's right for you. We are fiduciary in nature, and we help those people, and we have a responsibility to do what's in your best interest. So,
well, there's not. You were talking about coming into the show this morning and coming into the radio station rather, and you were talking about safety, and all that. Like you say, is great as long as they can offer you more than just steak. They can offer you fish. They can offer you chicken. They can offer you pork. They can offer you everything.
Exactly.
So you've got folks out there that just can offer the fish, and you got folks out there that can just offer the steak.
Exactly.
So when you're talking about the broker who has a suitability to you, not a fiduciary, and fiduciary means they're sitting on your side of the table.
Brian, I'm going to have to cut you off. We're going into a bumper here, Brian, but we're going to come back and talk about the difference between a broker, a salesman, and a fiduciary, and we're going to get into how to make money in this sideways market. You're listening to the Financial Freedom Show.
That tonight's gonna be a good night. That tonight's gonna be a good night. That tonight's gonna be a good night.
You're listening to Financial Freedom, a show about living the best years of your life your way. Now, here's your host, Paul Taylor.
And welcome back. We are live this morning. If you'd like to talk with us or have any questions about any of the subjects we're talking about, you can reach us at 704-570-9610. Just call into the station. And we have a very special guest today. We have Brian Geiser with Geiser Financial out of Greensboro. And just wanted to say thank you for getting up so early this morning, Brian.
Oh, it's pretty normal. In our line of work, it seems like we never stop.
You got to stay up. You got to stay on it. Hey, Brian, right. Well, just a couple things. We had some emails come in last week from last week's show, and I've got a lot of people asking about Social Security, when to get on it, and I just wanted to let folks know that we're going to be doing a Social Security timing show within the next 4 weeks. I don't have that exactly scheduled yet, but also a couple other things. I thought I was coming in this morning, Brian. It seemed like every AM, FM, everything show I tuned into was talking about annuities. And, I just want to warn folks out there that can be you better be real careful when you're talking about annuities. And there's some good stuff, and there's some bad stuff, and there's some ugly stuff. And as a matter of fact, I'm going to call that show next week, The Good, the Bad, and the Ugly on Annuities. And so stay tuned for that. We're going to talk about that, what to watch for, and what to, kind of red flag, what you need to be aware of. And then also in 2 weeks, we're going to have Medicare and Medicare supplements. If you're coming onto the age 65 area, you need to know about Advantage plans versus supplements. So we're going to be talking about that. But Brian, right before we left at the break, we were talking about the difference between a fiduciary versus a broker. And I've got our studio help here.
Salesman,
yeah. And so what I'm going to do is I'm going to play about a 2.5 minute clip here explaining the difference, folks, because if you're working with a broker, you need to realize who you're working with and what the difference is and what a fiduciary has to do. So we're going to key that up and let's do it real quick.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in and you say, hey, Lou, I need to, I'm barbecuing this weekend, right? What do you like? And Lou goes to, the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal? Ooh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak. Just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit. It's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy. Your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart vis-a-vis my expectations for selling me that thing. By the same token, when I go to see a dietitian, I know she's going to look at all of my labs, she's going to take all the measurements, she's going to run all of her analysis, and she's going to absolutely give me her best thinking on what's best for me. Whether she's a vegetarian or a meat lover, likes this, likes that, if she thinks I should be doing something differently, even if it's not good for her, she's going to give me an opinion that's for my interest. So what's the difference between a fiduciary and the brokers? Well, these are dietitians, these are butchers. It's that simple. Brokers are butchers selling product. Fiduciaries are dietitians looking after your health. The problem is most people think that their butcher is a dietitian. So when one of your moms or dads or friends calls the broker and says, I got $200,000, I sold a little piece of property, or I got some inheritance, what should I do with it? They're going in thinking they're talking to a dietitian, and they're really talking to Lou the butcher.
That's a pretty powerful YouTube. If you just caught the end of that and you turned on the show, it's the dietitian versus the butcher. You've got two dietitians on the phone this morning, so you got two people that have fiduciary responsibility to do what's in their best interest for anybody that comes in their office or calls in. So that's why we're talking to you this morning, because knowledge is wealth, knowledge is money, and we are trying to bring knowledge to you, truthful knowledge, and not selling product. Brian, that YouTube, I love it, and I think it was just a great explanation of the difference in what we bring to the table.
I was just going to say, when you were talking about the butcher and all, and I want to make sure that it came through clear to the listeners, and if it didn't, they ought to go to YouTube and just put in butcher diet versus dietitian financial. And then it's a 2-minute video that explains the difference. And basically a broker, Paul, has a suitability to you. And what a suitability basically means is he's just got to make sure he fits your risk tolerance. He fits your risk, your objective, not necessarily what's in your best interest. Because if your objective is to get steak, but your cholesterol's high, he doesn't care that your cholesterol's high. He wants to give you the steaks you came in for. Where investment advisors is a totally different world. They're on your side of the table, and they're going to tell you the good, the bad, and the ugly. Like it or not, whether it's in their best interest or not, because it's all about you, not about just what you're asking for.
Well, and Brian,
they're going to clarify what's wrong and fix it.
Brian, one thing he was talking about there is, a lot of people hold out a shingle saying they're investment advisors, but they're still brokers at heart, and they're still selling product. If you hold certain licenses, you have to do fiduciary, you have to do what's best for the client, and those licenses that you and I hold require us to do that. So I just want to differentiate that, first of all. And one other thing is we do a bi-weekly class, a mini class where we expand on this a little bit more. We talk to people. We spend time on some charts, getting you to understand the difference between secular and a cyclical bear and bull market. You can call for that at 1-800-551-5086. We've got 5 locations in the Lake Norman and Charlotte area. all the way down to the Ballantyne, South Park area, just throughout the area. But you can call 800-551-5086 just to get more educated and learn a little bit more about this. But Brian,
basically, it's live operators. They'll take your information, and then Paul will get back to you.
Me or somebody from my office will, obviously.
Exactly.
So, but we I actually have a class coming up at 4:30 on Tuesday at my Huntersville office, and we cover an array of different things. And I'm not trying to get people just to come to that class. I'm just letting you know that's out there. If you want to come in, if you would like to just get more educated and see a little bit more about the truth that's out there and what to do in this crazy market, that's what we'll talk about. So back to this crazy market, Brian. We were talking about beginning the show, the difference between an active and a passive investment portfolio. A passive portfolio, folks, means you're just in a buy and hold mode. And we were talking about earlier, if you just bought and held in the S&P 500, Brian, you've only made 2% in 12 years on simple interest.
Coming up on 13 years.
Yeah, forget the compounding, simple interest. So 13 years, you've made 2%. You could have stayed in a money market, folks, and not risked any of your portfolio whatsoever and made the same money. Now, I know money markets right now are only paying about 0.5%, but at one time they were paying 3.5%. So you just got to be aware, and you've got to be ready, for these different things. So.
It's kind of hard to believe, but actually back in 2000, you could have bought yourself a 10-year, 7% fixed vehicle that would have doubled your money at this point in time.
It is. And at 2%,
it takes 36 years to double your money.
Yes, exactly. 36 years.
I mean, a lot of people were, because we were spoiled rotten by the 80s and 90s and that bull secular, that 17-year period where no matter what you put your money in, your money just grew, and it spoiled us rotten. We were like, 7%? I want more than that. And hindsight is definitely 20/20 in this case.
Yeah, a matter of fact, when I was doing some studies, remember I was talking a little bit earlier, it's not always how much you make, or it's what you keep, because in the NASDAQ composite, 10 years later, the index is still down 50% from what it went down in 2000. So, a lot of people think it's always going to just come back. Well, the NASDAQ hasn't. The S&P 500 has came back twice. We're at that high. That typically means optimism is high, and you need to be aware and be ready for, if there is a downturn. So
it's a pretty simple question. Ask yourself, if right now your listeners, if they cannot say, hey, this is my exit strategy in the event the market starts to crumble, and most people can't name it. And if you're one of those folks right now saying, hey, what is my exit strategy? What is the goal of my broker? What is the goal of my investment advisor? 95% of the people listening right now are in a buy and hold strategy, no matter what fancy name they hook to it.
Yep.
And they better. And the way you know if you're in one or not, just ask your advisor, hey, what's the exit strategy the next time we go through another 08 or another 01, 02?
Let's talk about that when we come back, Brian. We're going to go We're going to go to a break right now, but very good show today. We're live. We'll be back in a moment.
Welcome back to Financial Freedom, a show about living the best years of your life your way. Here's your host, Paul Taylor.
And good morning. We are live. If you'd like to call and give us ask any questions or discuss any of the topics we've been discussing this morning, you can call us at 704-570-9610 at the radio station. Also, you can link into our website if you have any email questions you'd like to send us at WFNZ.com or America's Talk Radio 1660.com. Now, by the way, if you've been driving and you're like, wow, I wish I'd have caught this full show, we will be playing on 1660 from 8 to 9 o'clock this exact show. So if you want to hear the full show, we've been covering the difference between a fiduciary versus a broker, which is same as a dietitian versus a meat salesperson, a butcher. So I couldn't think of that word. Thank you, Brian. And we also have
That's all right.
That's why I like having a guest on the radio show. So also we have live calling in early this morning, Brian Geyser from Geyser Financial out of Greensboro. So Brian, let's talk about getting a little bit more into the active and the passive portfolios. We were talking earlier about what type of market we're in, and I'm going to post that on my website, folks. You can go in and see a chart of what's the difference between a secular bull and a secular bear market. And we are currently in what's known as a secular bear market. We're in the 12th year, and it's pretty much if you've been in the market, you've made very little. And we were talking earlier on the S&P 500, even today, with it being at an all-time high this year, you've only earned a 2% income or interest per year while putting your money at risk during the last 12 and a half years, almost 13 years. So with that being said, I was looking at an article this morning, and it says it's not all about the gains. And I'm just going to read it here. It says, consider the notion that the markets always recover. With the benefits of hindsight and a 200-year data set, it might be a reasonable conclusion. But the question isn't whether markets always come back. It's whether they come back with an investor's time frame. That's very important. It's not a matter of where they come back. It's whether it comes back in your lifetime. And we have people come in all the time, Brian, and they're still in a, you spend 40 years accumulating pretty much in the workforce, wherever you're at, just accumulating assets, accumulating money. And people stay in that mindset and never go into any type of preservation. And they stay in that mindset that the market's the same, and it's not. That's what we're trying to teach you this morning, folks, is not. There is a difference. We are in a secular bull market, and you need to recognize it because you can't make money being passive. And so, anyways, on March 10th, 2000, Brian, the NASDAQ composite reached a high of 5,048. That's 10 years later, the index is still down over 50%. Is that not amazing? I forgot it was at 5,048, and I'm in this business.
Exactly. And actually, it's people I just don't think, it's kind of hard. We're in the moment. And even with our investment portfolio, we're in the moment. And we get into basically what is called a euphoria state. Well, golly, I'm comfortable now. It's always going to be this way. It's always going to be this way. And then literally in 1, 2, 3 days, the market just falls apart and literally takes back 3-4 years. And I think people forget that, Paul, and how detrimental that can be to their portfolio.
And it happens all the time. And it's even happened within this year, even though the S&P 500 year date's up 18%. Just a matter of 4 months ago, we were down. And people forget that. So we've just had a really good run here. But, Brian, let me go a little bit further on this. Unfortunately, this isn't the only lost decade. Now, from December 1968 to August 1982, that's almost, 14 years?
15 years.
15 years. The S&P 500 index measured a loss of 1.18%. So 15 years. In other words, it's a 14-year commitment to the stock market. You had less money than when you started. Even worse, on March of 1999 through March of 2009, now this is just recently, folks, a period now all too familiar to present-day investors, the S&P 500 posted a loss of nearly 40%. And that's what we're trying to get you to understand. We are in a secular bear market, and you need to recognize that. And when you're in a secular bear market, you cannot just buy and hold. And that's what we're talking about today is the difference between active and passive portfolios.
And Paul, what they also got to think about, they've got to think about their age. And if you're 70 years old and lose 40%, what if you're withdrawing income from that instrument that just lost 40%?
Exactly.
Now you just added a double negative to it.
Exactly. And if you're pulling income from it, it's even worse because now you're doing what's known as reverse dollar cost averaging, which is more dangerous than just the market going down. You're sitting there pulling money out while it's going down. So
Paul, if you lose 50% of your portfolio this year, you got to make 100% next year just to break even.
Mm-hmm.
And people don't really put those numbers in perspective, and that's what your class does when you're having Tuesday. Really puts those numbers in perspective, really puts a little meat to those bones, if you will.
Exactly. And so, and that brings a good point, Brian. Folks, if you would like to attend any of our mini seminars that we do throughout the month, you can call 1-800-551-5086. Live operator there if you have any questions about it. They'll get some information from you, and I'll give you a call back and let you know the different locations and when we're doing that. We've got 5 different locations, so it's very hard for me to list all that over the radio and the time. So just give us a call. And right now those are free, but I don't think they're going to be free much longer because I'm tired of doing them for free, to be honest with you. But we are trying to educate the general public out there. And, folks, today we're actually live. If you want to give us a call at 704-570-9610, 570-9610, give us a call at the station if you have any questions. So, Brian, let's get back to passive versus an active. Now, we've got a number of different institutional money managers we utilize. I realize that being in this business, I can't be sitting in front of a client, meeting with people, and being able to do the trading at the same time so we really rely heavily on institutional money managers. And we clear through, Trust Company of America, Pershing, Schwab, a number of different banks, but we clear through them so that we can have access to the best managers that are in your best interest. And, the difference between a passive and active is a number of our active, our tactical trading portfolio managers actually made money or didn't lose money in 2008. Brian, what are your thoughts on that?
Well, basically, in a nutshell, what it boils down to is if you're in a passive portfolio, if you have a passive by nature portfolio, you have no exit strategy. You're in for the 10, 20, 30-year long haul, and wherever the roller coaster takes you, off you go. Well, you can't just choose a passive. You've got to play to the market. You can't make the market do what you want to do. So what a tactical strategy or an active managed strategy does for you, and rebalancing is a form of active manage, but it's also a form of buy and hold, and it just rebalances over time. Well, what a truly active manage does, it gives you that exit strategy, because a lot of folks would have loved to have made 1% in 08 instead of minus 40, 50%. Mm-hmm. And that's what more of an active managed portfolio does for you. It inserts and puts in there exit strategies. And basically, in a nutshell, what an active portfolio does is they study history and charts to determine whether to be in the market or get out of the market.
Exactly.
And once again, if we go back to that example we just said, if you lose 50%, you got to make 100%. A lot of folks lost 40%, and they've got to make now, 70, 80% just to get back to even. Most people aren't even from the 2008 because they got scared. They jumped into cash. The markets came up a lot. Then they got back in the market.
Exactly.
People Paul, really never look into it from that standpoint. They never think about it from the standpoint that, hey, my emotion's going to play an effect on whether I'm in the market or not, because you freaked out and you told your broker after you lost all that money to get you out.
Well,
and you didn't get back in till later. What the active management portfolio does is helps to eliminate making stupid decisions out of emotion.
And that's what we're going to get into in detail. We've got a number of active managements that are tactically traded, but right now we've got to go to a break, Brian. It's unbelievable how quick we're going this morning, but we'll be right back. You're listening to the Financial Freedom Show.
You're listening to Financial Freedom, a show about living the best years of your life your way. Now, here's your host, Paul Taylor.
And welcome back. We're actually doing the show live this morning. You can call in at 704-570-9610 if you have any questions or would like to discuss any of the topics at hand. Also, I am the president of Capital Advisory Group, and we have a number of mini seminars that we put on each month throughout the Charlotte area and Lake Norman area. And if you'd like to attend one of these seminars, what these are is just educational, because I believe knowledge is wealth. And you can reach a live operator at 800-551-5086, 551-5086. Also, if you are catching the end of the show or want to listen to more of the show, we're actually doing this portion of it live, but we're going to be on America's Talk 1660 from 8 to 9 o'clock a little bit later on. But we have a very exciting guest on the show this morning, Mr. Brian Geiser out of Greensboro of Geiser Financial. Brian is a fiduciary advisor, and we played a very good, what I consider a very good YouTube video a little bit earlier that talks about the difference between a fiduciary and a broker. Brian, we've been talking about the difference between tactical or active versus passive. A lot of folks don't believe that timing, that there's no way to time the market, but when in fact, and I've got a good article, in fact, I'm going to put this on our website too. You can link over to WFNZ.com and link into our website at capitaladvgroup.com. And I will put this active investment management and time verifying investor risk premium article that talks about that you can actually, a good tactical manager can time the market. I wouldn't say time it because I want to use that very carefully. But what there are is there's optimism. There's definite factors they can go by when things are at a high, when there's times to actually you can even make money when the market's going down. And this is what a good active and tactical trading manager will do versus a passive manager. Brian, we were talking before, I think of the second segment, that the S&P 500, if you've just been buying and holding, you've barely broken even after almost 12 and a half years. Are you there?
Exactly.
There you
and I think something to kind of clarify what a passive manager is going to participate in the ups, the downs, everything. And an active manager, the number one thing an active manager does, because it's not all about gains, it's about avoiding losses. I think one of the truest statements I ever heard, Paul, if you want to make your money last a lifetime, it's not the big gains that you get, it's avoiding the big losses. And proof of that is if you go back all the way back to 1981 to 2009, if you just take the S&P index and you put $1,000 in there, all the way through 2009, your money would have still gained 6.6% on a passive strategy where you participated in both sides.
Mm-hmm.
You'd today have about as of 2009, $6,378. So that's a 6.6% average on $1,000 over that period of time. Now, of course, that's 27 years. Now, if you would have missed the 10 best days, your average would have been 4%, and today you'd have about $3,000. But if you missed the 10 worst days, you had averaged 10%, and you'd have $16,595. That's a $10,000, more than double of just sitting there. So the key is the biggest thing that a active manager will do is miss the 10 worst days. That will really put a hurting on your portfolio.
Well, here's what a good active manager is going to do. They're going to, and once again, folks, our company relies on institutional money managers. There's no way I have the information coming into my office that an institutional guy is going to have. But and they run the show anyways. They can manipulate the market, but bottom line is a good tactical trading manager will participate on 85% of the upswing and 15% of the downswing. So they're not going to get 100% return on the upswing, and that's fine. But what you want is make sure they're not participating on 100% of the downswing. And so a good tactical
manager. And the numbers don't lie. You know what I mean? The numbers just don't lie.
Well, and we've got five different managers we've utilized that actually, out of three of them, they didn't even have a downturn in 2008. I mean, so you get the right information, you get the right quality of managers. They're going to know where optimism is. They're going to know tactically what needs to be doing, where they need to be, and how to make money even in a sideways market.
And another thing, by leaving it to the proper active managers, you got to choose in this business. Do you want to gather assets or do you want to manage assets? And our asset managers are certified financial analysts. That's all they do. They don't go out and gather assets. They manage the assets that folks like Paul and I bring to them.
That's a great point, Brian. And, once again, folks, if you're just tuning into the show, what we've been talking about is we are in what's known as a secular bear market. We're 12 and a half years in it. Basically, if you've had money invested in, I don't care if you're with a mutual fund manager or indice or whatever, 85% of mutual fund managers don't even beat the indices. So a lot of times on my show, you'll hear me always refer to the S&P 500. It is the broadest index other than the NASDAQ, but it gives you a good heartbeat of what's going on. And what we were talking about is if you've just been buying and holding, that approach is not working. Bottom line, if you've never sat down and you're putting money in a 401k and you've never really looked at, hey, how's my 401k doing without my money that I'm putting in or without the matching my employer's doing? What's the market been doing? That's what we're trying to get you to understand this morning is what it has been doing. And
right, and there's a lot of indicators, Paul, that people need to realize that, right now we are in a presidential election season. They're going to do everything they can to prop this deal up. And proof of that is that we went to a 7.8 unemployment rate only on the backs of people quit looking for jobs. I mean, so they're skewing the numbers heavily right now, which only sets us up for a much larger drop when it finally does happen.
Yeah, and, I think most of the listeners realize that that's exactly what's going on. I mean, there's still a lot of people unemployed, a lot of people that, have taken salary decreases, a lot of different things going on. But so, folks, today, if you'd like to attend one of our what we call a mini seminar or mini class, give us a call, 1-800-551-5086. You're more welcome to sign up for one of those if we've got room, and we will put you in there. And we've got 5 different locations in the Charlotte and Lake Norman area. Go ahead, Brian.
And I think it's important for them to understand you're not there to ask them for business. They're there to learn. There won't be anybody, hey, you want an appointment? Now, you want an appointment with Paul, or if you just want to sit with him one-on-one, you can do that as well. But I think what's most important here, you're there to learn. It's a very study session. If you remember back in college, you'd get together with 6 or 8 or 10 of your friends, and you would study, and you'd get a lot out of it, and you'd communicate. It's an environment like that. And no 2 classes are really alike, and you get a whole lot out of it. You will take home nuggets. He has a workbook. He's going to give you websites. He's going to show you how to do some small, simple charts. Folks, it's worth your time. If you don't do it, it could literally and potentially save you from one of these 40-50% drops once you have the knowledge, as Paul likes to say.
And Brian, one of the things that we talk about in there, just folks, so you'll know, is exactly what we're talking about on the radio today. And next week I'm going to do a show on annuities, the good, the bad, the ugly. If you're looking at annuity, be careful. Listen to our show next week before you do anything. You need to be aware. I keep turning on radio shows, and that's all they're talking about is annuity, guarantee. And you need they're good things, but you need to be careful. There's some
right.
good, bad,
and
ugly.
A Hail Mary pass is a good thing, but you don't do that from the 1 yard line. You know what I mean? You don't do that from the opponent's 1 yard line. You rush your fullback. And so it's just a matter of, it's not that there's bad tools out there. They're just poorly used tools.
Correct.
And used at the wrong time.
Correct.
Everything's not a Hail Mary pass. Everything's not a 1 yard rush, bull rush. It depends on where you are in the field. And we can't control the winds of the market, but we certainly can control the sails of our sailboat. And that's what active management does. And that's what we're all about. We're all about looking at your overall picture, and you should be too, and then prescribing accordingly.
So this week we've been talking about how to make money in the market, in a sideways market, what to do. Next week we're going to talk about more guarantee stuff, how to make money out of the market, even in this low interest rate environment, and what your options are. But Brian, once again, I really appreciate you getting up on this early Saturday morning, and Folks, if you're just tuning in and you want to hear more about this show, we will be doing the show again from 8 to 9 on 1660. This is Paul Taylor with the Financial Freedom Show, president and owner of Capital Advisor Group. Thank you and have a blessed day.